Hi everyone, hope all are fine. Today we made a video on Ind AS 2 inventories. Myself Bhargav, let's go to today's topics for discussion. Our discussion has been divided into 6 parts. Number 1, definitions. Number 2, how to measure inventories in case of single product. Number 3, in case of joint and byproducts. Number 4, cost formulas used to arrive at cost. Number 5, net realizable value write-downs and reversals. Number 6, items to be recognized as expense. First topic, definitions. Number 1, what are inventories? Inventories are assets held for sale in the ordinary course of business or in the process of production for such sale or in the form of materials or supplies to be consumed in the production process or in rendering of services. Simply, we can classify them as finished goods, work in progress and raw materials. Next definition, fair value. Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at measurement date. Next, final definition, net realizable value. To arrive at net realizable value, estimated selling price in the ordinary course of business has to be deducted with estimated costs of completion and estimated costs necessary to make such a sale. Let's take an example to understand this better. There are 3 different categories of inventories at the end of the year: raw material, work in progress and finished good. In our example, the finished good is chapati roll which costs 50 rupees. So the estimated selling price of FG comes to 50 rupees. Raw material, that is vegetables, and work in progress half boiled curry cannot be served to customers directly. Hence, they must be converted to chapati roll and then we can serve. So the estimated selling price of raw material as well as work in progress will also be 50. Further processing costs of raw material and work in progress are 10 and 5, whereas the finished good is already completed, so the cost of completion is nil. Then estimated cost necessary to make sale, that is restaurant cost or serving fee, whatever, comes to 10 each. As per Ind AS 2, net realizable value is equal to estimated selling price minus estimated cost of completion and estimated cost necessary to make a sale. Therefore, NRV of raw material, work in progress and finished good comes to 30 rupees, 35 rupees and 40 rupees. From the above definitions, it is very clear that NRV is not equal to fair value because NRV is the estimate whereas the fair value is the actual price. Clear? Our next topic, measurement of inventories in case of single product. Inventories are measured at lower of cost or net realizable value. Cost includes cost of purchase, cost of conversion and other costs. Under cost of purchase, add the following items: purchase price, duties and taxes which are non-refundable, transport and handling charges, then other related costs to bring the inventory to present location and condition. From the above, we have to remove any trade discounts, rebates and other similar items. Under cost of conversion, add direct material, direct labor and other direct costs and allocate overheads. Here we have 2 types of overheads. One is variable overhead and the other one is fixed overhead. Variable overhead will vary with volume of production, hence no problem in its allocation. The other hand, fixed overhead will remain constant and do not vary with volume of production. So little concentration is required in its allocation. Case number 1. If actual production is greater than or equal to normal capacity, then entire fixed overhead will be included in the cost of conversion. Reason, we have fully utilized our capacity. Case number 2. If actual production is less than normal capacity, then utilized portion of fixed overhead will be included in cost of conversion and the remaining unutilized capacity will be charged to profit and loss account. Let's see one example on this. We have a Xerox machine for which annual maintenance costs 10,000. During 1 year, we can produce 10,000 copies. So our normal capacity is 10,000. But we produced only 8,000. Actual production is 8,000. So fixed overhead of 10,000 has to be allocated as follows. To the extent of utilized portion of capacity, include it in cost of conversion. So the actual production 8,000 copies multiplied by fixed overhead cost of 10,000 divided by normal capacity 10,000 copies, which comes to 8,000 rupees. Next, the balance unutilized portion of fixed overhead will be charged to profit and loss account. That is total fixed overhead minus allocated to cost of conversion, which comes to 2,000. Next, other costs. Under this, consider all other costs not included in purchase or conversion but incurred to bring the inventory to present location and condition. Refer note 1 at your end to know the cost to be excluded from cost of inventory. Then also consider borrowing costs if Ind AS 23 permits. On other hand, it is NRV. Net realizable value will be the estimated selling price in ordinary course of business, which has to be reduced by estimated cost of completion and estimated cost necessary to make such a sale. Let's understand this slide with an example now. Sweet Construction is a construction company which construct buildings and sold to customers. At the year end, we as an accountant required to value our buildings. Cost particulars are as follows. Cost of purchase consists of purchase price of land costing 50 lakhs. Taxes paid on them amounting to 1 lakh. Discount given by landowner 3 lakhs. And other clearing cost comes to 20,000. So the total cost of purchases amounts to 48 lakh 20,000. Next head, costs of conversion, which consists of direct materials 35 lakhs, direct labor 25 lakhs, variable overhead costing 2 lakhs and fixed overhead monthly rent costing 80,000. So the total cost of conversion amounts to 62 lakhs 80,000. So as per Ind AS 2, cost of inventory includes cost of purchase, cost of conversion and other costs. So 48 lakh 20,000 plus 62 lakh 80,000 plus other costs 4 lakhs, which comes to 1.15 crore. Net realizable value is the estimated selling price minus estimated cost of completion and estimated cost necessary to make a sale. Estimated selling price is 2 crore. Building is already finished, so there is no cost of completion, and estimated cost necessary to make sale or 10 lakhs. So the NRV comes to 1.9 crore. Inventories are valued at lower of cost or net realizable value. In our case, it's cost. So value of inventory, the building, is 1.15 crore. Clear? Our next topic, measurement of inventories in case of joint and byproduct. When more than one product is produced in the process, if the outcome is joint products for which costs are separately identifiable, then cost of each product is based on separate cost incurred. Suppose if the outcome is joint product for which costs are not separately identifiable, then allocation of cost is based on relative sales value of each product. On other hand, when more than one product is produced in the process and if the outcome is main product with a byproduct, we have to see whether the byproduct is material or immaterial. If the byproduct is immaterial, measure byproduct at NRV and this value has to be deducted from cost of the main product. If the byproduct is material, treat byproduct as joint product and accordingly accounting will be done. Now let's see one example on this. Indian Timbers produces grade A and grade B lumber from a log. Along with lumber, it gets a sawdust while processing. Here, lumber is joint product and the sawdust is the byproduct. Grade A, 1 cubic feet value is 5,000, grade B value is 4,000 and sawdust value is 300. Indian Timbers processed 10 cubic feet log which cost 20,000. The processing cost amount to 10,000. So the total cost amount to 30,000. This is the joint cost of grade A, grade B and sawdust. In our example, outcome is joint products and the cost is not separately identifiable. We have to use relative sales value to allocate joint cost. Sales value of grade A is 10 cubic feet into 5,000 which comes to 50,000. Grade B sales value 40,000. So the joint cost of 30,000 has to be allocated between joint products in 5:4 ratio. But before allocation of joint cost, we need to consider byproduct at NRV which amounts to 3,000 which has to be removed from cost. After deducting scrap value, cost comes to 27,000. Now allocate this cost to grade A and grade B in 5:4 ratio. So the cost of grade A will be 15,000 and cost of grade B will be 12,000. Inventories are valued at lower of cost or net realizable value. Since sales value is more than cost, hence value of inventory of grade A will be 15,000 and grade B will be 12,000. Next topic, cost formulas. These are used for our convenience and can be used only if these formulas will result in actual cost. Most commonly used inventory valuation techniques are: in case of inventories, ordinarily interchangeable, that is, when group of similar items are present, we can use either historical cost method like FIFO and weighted average cost, or we can use non-historical methods like retail inventory method or standard cost method. Depends on the availability of information with us. Retail method. It is used widely by retail industries when large number of rapidly changing items with similar margins are involved. Here, cost is determined by reducing the sales value of inventory by appropriate gross margin. So we need to know gross margin as well as sales value. Another non-historical method is standard cost method. It takes into account normal levels of materials, supplies, labor efficiency and capacity utilization. These must be regularly reviewed. Next, other side. Inventory not ordinarily interchangeable, that is, for specific projects, specific identification method is used. Generally, this method is used in jewelry, tailor-made industries. Let's see an example on retail method and standard cost method. Big Basket is an Indian online grocery delivery service which has a gross margin of 15% on each item. At the year end, inventory of one of the brands is as follows: 100 kgs of potatoes, which MRP is 30 per kg, 50 kgs of onions, MRP 40 per kg, 20 kgs of carrot, MRP 50 per kg are left. As the items are ordinarily interchangeable, that is group items, and with similar gross margin, Big Basket chooses retail method for valuing cost of inventory. So under retail method, to arrive at cost, sales value of inventory is deducted by gross margin. So cost of potatoes is 100 into 30 minus 15%, which comes to 2550. Similarly for onions it's 1700, for carrots it's 850. Now NRV of potatoes, 250 is the delivery charge, so sales value minus delivery charge, which comes to 2750 in case of potato, 1750 in case of onions and 750 in case of carrots. The golden rule: inventory is valued at cost or net realizable value, whichever is lower. In case of potato it's cost, which is 2550. For onions it's again cost 1700, but in case of carrots it's NRV, which is 750. Hence the value of inventory comes to 5000. Now standard cost example. Arvind Limited is a textile manufacturer which manufactures shirts and jeans. When a shirt is produced, 10% of direct materials, 15% of direct labor, 5% of other costs will be borne by it. During the year, direct materials amounts to 20 lakhs, direct labor amounts to 25 lakhs and other costs 10 lakhs were incurred. 10,000 shirts were produced during the year and at the year end inventory is 2,000 shirts. As the items are ordinarily interchangeable and with levels of materials, labor and other costs, Arvind Limited chooses standard cost method to value cost of inventory. So cost of 2,000 shirts or direct materials, 20 lakhs into 10% multiplied by 2,000 divided by 10,000, which comes to 40,000. Next, direct labor, 25 lakhs into 15% multiplied by 2000 divided by 10,000, which comes to 75,000. Other cost 10 lakhs into 5% multiplied by 2000 divided by 10,000, which comes to 10,000. Shirt total cost comes to 40,000 plus 75,000 plus 10,000, 1,25,000 is the cost. NRV, estimated selling price, is 500. Cost of completion comes to 100 rupees. So 2000 into 500 minus 100, which comes to 8 lakhs. Inventory is valued at lower of cost or NRV. Therefore, inventory value is 1,25,000. Our next topic, writing inventories down to net realizable value and its reversals. Materials and other supplies held for use in the production of inventories are not written down below cost if the finished products are expected to be sold at or above cost. However, when there has been a decline in prices of material and it is estimated that the cost of finished products will exceed net realizable value, raw materials is measured at replacement cost measured as NRV. Next, reversal of write down. When there is a clear evidence of an increase in net realizable value in subsequent period assessment, the amount of write down is reversed, but the reversal is limited to the amount of original write down, so that the new carrying amount will be the amount equal to lower of cost or NRV. Our last topic, items to be recognized as expense. Amount of inventory is recognized as an expense or 1. Carrying amount of inventory sold in the period in which related revenue is recognized, that is cost of goods sold. Next, amount of any write down of inventories to NRV, and also all losses shall be recognized as reduced by any reversal of write downs. Last point, some inventories may be allocated to other assets where the inventory will be capitalized to such asset. So inventory is allocated to be depreciated over the useful life of the asset. So the depreciation will be treated as expense in the period. Please go through disclosures and notes at your end. Today we have covered definitions, measurement of inventories, joint and byproducts, cost formulas, net realizable value, write down and reversals, and items to be recognized as an expense. In case of any doubts, please comment below. Thank you so much, guys. Take